Hey, income chasers, switching gears this week. T-bills are fading, yields are slipping, and dividends are back in the hot seat for every Singapore investor. Feeling stuck figuring out where to still get decent returns without loaded up risk? You're not alone. Today, I'll break down a no-fluff, data-driven playbook for using SGX Dividend ETFs to pull in income, even as rates move and REITs wobble. This is adapted straight from my latest in-depth Substack deep dive, full link in description. If you're after simple cash flow which still fits inside CPF, SRS, or just a regular brokerage, this video's for you. I'm Iggy from the Investing Iguana. I cover Singapore markets, real talk, evidence, easy to follow steps. I used to run institutional money. Now I help local investors skip costly mistakes and build smarter portfolios, Singapore style. Here's how we'll roll today, mapped exactly to the article. What's driving the rush? Back to dividend ETFs, and what made the top 10 cut. Breakdown of key ETF roles and yields, what's inside each fund. Deep dive, what really drives these yields, section by section. The engine system, matching each ETF type to your income plan, with CPF and SRS fit. Concrete buy, hold, sell calls, and risk controls. Tables and frameworks, all described. Playbook, my personal strategy and portfolio split recommendations. Action kit, how you can put it all together now. Let's do this. Singapore's at a crossroads for income investing. T-bill rates that made headlines last year are down. Fixed deposits? Less tempting. But the bills keep coming. Like most of you, stability and repeatability are what matter. No FOMO, just monthly cash. If that's you, today's deep dive was made to give clarity, not hype. I break down the top 10 dividend-paying ETFs on SGX as of June 2025, spell out what's inside, REITs, bank stocks, USD bonds, and show which funds really fit real-world Singapore use cases. Think CPF, SRS, retirement, and tax. Here's the key. Don't trust headline yield alone. Some ETFs pay more because they lean heavier into risk. Think high-yield bonds. Some because they're cyclical, like bank-heavy funds, and others are rate-sensitive, like REITs. To win, you need to match yield source with your risk budget and time horizon. Do that, and these ETFs can power your long-term plan and help beat inflation without jaw-dropping losses when things get rough. We're diving into a framework. Which ETF fits where? What can go wrong? How do you size it? And finally, buy, hold, or sell right now for each fund. Let's introduce the players, along with their main jobs and yields. Round as of June 2025, iShares USD, Asia High Yield Bond ETF around 7.4% yield is Asia ex-Japan High Yield Credit, juicy coupons but high default risk. CSOP iEdge S-REIT Leaders ETF around 6.0%. Your large cap, top SG REIT play, offering scale and liquidity. Nikko AM Straits trading Asia. Ex-Japan REIT ETF around 5.8%. APAC regional REITs with some Hong Kong flavor. Lion Philip S REIT ETF about 5.8%. Focuses on Singapore REITs. Loved by retail for its liquidity. Lion OCBC Securities SG Low Carbon Index ETF about 5.7%. Singapore equities with a clean energy lean. Delivered strong multi-year returns. Lion OCBC Securities APAC Financials Dividend Plus ETF, about 5.6%. 30 APAC financial giants, cyclical, but delivers if banks perform. SPDR STI ETF, 4 to 5%. Your Singapore Blue Chip Foundation, anchored by banks. iShares JP Morgan USD. Asia Credit Bond ETF, about 4.3% USD. Asia Bonds, higher quality, longer maturities, think lower drama. Philip SGX APAC. APAC Dividend Leaders REIT ETF, about 4.3%, regional, high dividend REITs with modest size, and UOB APAC. Green REIT ETF, about 4.1%, ESG focused, recent star among REIT ETFs. Picture a table mapping each ETF with its main exposure. REITs, credit, banks, normal yield, and its typical job in an income plan. For example, iShares USD. Asia, HY bond is speculative income, while Lion OCBC low carbon is core. The big tip here, don't own 3 nearly identical REIT ETFs. Pick your sector, focus, and check if you're doubling up fees unnecessarily. Let's decode what's behind those percent numbers. Here's the plain English breakdown. REIT ETFs, around 4 to 6%. Income comes mostly from rent minus borrowing costs. As rates peak and fall, REITs can stay attractive and see some price gains. However, watch leverage, refinancing, and property type. Data centers and logistics are more solid. Office REITs are still iffy. Asia USD credit, 4 to 7% or more, offers the highest yields with higher default risk, especially property-linked names. Safer investment grade gives less, but is steadier. Duration, maturity length, matters now. If rate cuts happen, longer maturity funds benefit, but if cuts stall, prepare for price swings. Singapore equities, low carbon, 5-6%. Funds screen out heavy polluters and tilt towards companies with healthy balance sheets. Payouts link with profits and current policy. You get exposure to STI big names, future-proofed with green metrics. APAC financials, 5 to 6%. Banks and insurers are cashed up. If rate cuts squeeze net interest margins, be ready for shifts toward fees and cost cuts. Diversified regionally, but sharp downturns can hurt quickly. Here's the table again in words. Every asset class has a risk lever. REITs swing with rates and commercial sector health. High-yield bonds swing with defaults, and banks depend heavily on margins. Match this driver with your own risk tolerance and income timing. Picture your portfolio like a car with 3 engines. Core income, stable, tax efficient. For this, SPDR STI ETF and Lion OCBC low carbon do the job. Broad Singapore exposure, fits SRS. Watch for bank/property cycles. Income plus, higher yield at slightly higher risk. Pick one REIT ETF, CSOP for pure Singapore scale, Lion Phillip for liquidity, Nico AM for APAC flavor, or add UOB APAC. Green REIT for ESG leaners, opportunistic yield, only for the adventurous, iShares USD. Asia High Yield Bond is the highest payer, but most volatile, so keep this small and diversify well. Imagine 3 sample portfolios as shown in the implementation grid. Income first leans heavy on core and a main REIT. Balance splits core, REIT, credit with a side of ESG, and growth with income keeps more powder for higher risk sleeves but diversifies. Keep the HY bond sleeve small, under 5%. Use cash not just as buffer, but as a buy weakness, not strength, opportunity pot. Buy, hold, sell calls as at August 2025. Buy, CSOP S-REIT leaders. Income plus, room to run as rates drop further. Lion OCBC SG low carbon. Core play, strong returns, sustainable tilt. Hold, SPDR STI ETF. Banking exposure priced in, but keeps paying. UOB APAC, green REIT. Good ESG satellite, building momentum. Nico AM or Lion Phillip S REIT. Pick one, don't double up. Lion OCBC APAC. Financials, hold but keep an eye on margin shifts as rates cut. iShares, JPM Asia Credit, steady and decent carry. Spec buy, small allocation, iShares USD, Asia High Yield Bond, only for those who can take drawdowns. Sizing tip from the rationale table, no single sleeve above 25%, HY bond stays tiny, under 5%, REIT ETF up to 15% max, core sleeves 20-25% each. Let liquidity needs guide sizing. SRS. Dividend ETFs love SRS. Tax deferral and reinvestment means pair SPDR STI, low carbon, and one REIT ETF for compounding engine. CPF. CPFIS eligibility is narrow. OA risk budget's low. Most use T-bills or SSBs in CPF. Keep ETFs in cash or SRS. Rebalance as needed. SGX listed ETFs pay out local exposure, so you avoid cross-border withholding. With APAC or USD bond ETFs, there may be international index level leakage, so focus on net yield, not headline. Key risks. rates path. If inflation sticks and cuts don't come, REITs and long-term bonds lag or lose. Don't concentrate in one sleeve. Credit, Asia or HY bonds bunch into property names. Trouble means payout pain, so diversify. REIT variety, not all assets are equal. Data centers/logistics strong, offices lag, especially in China retail. Liquidity, small ETFs can go illiquid fast. Always use limit orders, avoid large positions in thin funds. Currency, USD credit ETFs add FX risk, so decide if it fits your plan and keep small. Risk checklist, respect sizing, diversify, and use each sleeve for its job, not fast gains. Implementation playbook, aim for a 4.5-5.5% target yield, diversify, and expect total returns to rise as rates cut. Core, 40 to 50%, split between STI ETF and low carbon ETF. Income plus, 30-35%. One main S-REIT ETF, up to 10% to UOB APAC Green for ESG. Credit, 15 to 20%. iShares, JPM Asia, credit base, HY bond as a seasoning for those okay with swings. Cash, 5 to 10% to buy dips. REITs are seeing better flows and pricing into mid-2025. Banks are stable but not cheap, and a low-carbon tilt keeps SG equity yield in play. Asia USD credit gives carry. Duration helps if and when cuts arrive. Sector mix matters. CSOP S-REIT, anchored by big diversified SG names. Strong flows. Lion Phillip is for liquid, yield-centered trade, and Nikko AM adds APAC layer. Takeaways, build income in buckets. Core SG stocks, REIT for extra yield, credit for carry, each with its job. Own one main S-REIT ETF to avoid duplication. Let sector mix and liquidity decide. Keep HY bond slivers tiny, they pay until things break. Use SRS to defer tax and compound faster. Rebalance twice a year, add on dips. Never chase yield in a rally. If you want the actual charts, full checklists, and written breakdowns, grab the deep dive on Substack. Link is in the description below. My take, play it barbell style. Core in STI or low carbon, add a Yahoo S-REIT ETF, Eileen CSOP for scale and liquidity. Keep HY and smaller REITs as seasoning. SRS is the best home unless you've maxed it. Then keep dividends in cash and rebalance as needs change. Rate path is the wild card. If cuts stick, duration helps and REITs shine. If not, be patient and size smaller where drawdown risk lurks. CPF, use only if CPFIS lets you and you are prepared for risk. I prefer SSBs or T-bills for now. Most of all, don't chase yield. Build flexibility so you buy weakness, not sell in panic. Singapore is in a golden age for building income the boring way. Use data, sizing, and fit. Let the post-Malaysia ads run past. You're building for years, not quarters. So here's the wrap. Match yield engine to your needs. Core, plus, and opportunistic sleeves. Pick, roll, not just rate. So each ETF does a job. Keep your biggest allocations to the core with seasoning in the plus and opportunity buckets. Use SRS and tax shelters where possible. Rebalance, never chase, never bet the farm on a single name. You can take these lessons into your Singapore investing journey and build real income with a safety net. If this script helped you, give a thumbs up, subscribe, and ring the bell. For the full playbook, tables, and member community access, grab today's Substack. Premium unlocks all the extra deep dives, custom checklists, and discussion threads. Don't snooze.